Imagine waking up on a Monday morning, checking your brokerage account, and seeing that several companies have deposited cash into your account while you were sleeping. No boss, no commute, and no active work required. This is the power of dividend growth investing. In a world of volatile tech stocks and uncertain markets, dividends are the cold, hard cash that provides a margin of safety for your portfolio. But in 2026, you shouldn't just chase the highest yield you can find. High yields are often yield traps that signal a company in trouble. Instead, we look for dividend growth companies that don't just pay you, but give you a raise every single year. Today, I am breaking down the 5 best dividend ETFs for 2026 that will help you build a snowball of passive income that grows larger every month. Before we reveal the top 5, we need to understand why dividend investing is so powerful right now. We are living in an era where market valuations are high. Dividends provide a return on investment that doesn't depend on the stock price going up. If the market goes sideways for 3 years, the dividend investor is still making money. Furthermore, reinvesting those dividends, a process known as DGRO, allows you to buy more shares when prices are low, accelerating your wealth through the power of compound interest. Our first pick is the undisputed king of the sector, SCHD, the Schwab US Dividend Equity ETF. SCHD doesn't just look for high yield, it looks for quality. It tracks the Dow Jones US Dividend 100 Index, focusing on companies with strong cash flows and a consistent track record of paying dividends for at least 10 consecutive years. With a low expense ratio and a history of double-digit dividend growth, SCHD is the foundation of any passive income portfolio. Next, at number 2, we have VIGI, the Vanguard Dividend Appreciation ETF. If SCHD is about current yield and quality, VIGI is about the future. This fund specifically targets dividend achievers, companies that have increased their dividends for at least 10 consecutive years but might have lower current yields. Why by this? Is because these companies, like Microsoft or United Health, are growing their earnings rapidly. Over time, the yield on your original cost will skyrocket as they continue to hike their payouts. Moving to number 3, we have a global powerhouse, VIGI, the Vanguard International Dividend Appreciation ETF. Most investors have home country bias, meaning they only buy US stocks. But some of the best dividend payers in the world are located in Europe and Asia. VIGI gives you exposure to high-quality international companies with growing dividends, providing you with a global shield and currency diversification that is vital in the 2026 economy. For our fourth pick, we look at a slightly different strategy for those who need higher immediate income. DGRO, the iShares Core Dividend Growth ETF. DGRO offers a massive diversified portfolio of over 400 stocks. It requires companies to have a positive earnings forecast and a sustainable payout ratio. This ensures that the dividends you receive today are safe and likely to grow, even if the economy hits a rough patch. It's a perfect middle ground between the aggressive growth of tech and the stability of traditional value stocks. Finally, at number 5, we have the income booster for 2026, JEPI, the JP Morgan Equity Premium Income ETF. Now, a word of caution: JEPI is not a traditional dividend growth fund. It uses a covered call strategy to generate massive monthly income, often yielding between 7 and 10%. While it won't grow as much as SCHD or VIGI over the long term, it is an incredible tool for those who want to see significant cash hitting their account every single month right now. In a balanced portfolio, JEPI acts as the income engine while the other 4 act as the growth engines. So, how do you build this? You don't need to buy all 5. For most people, a combination of SCHD for quality and VIGI for growth is enough. If you are younger, lean 80% into the growth side. If you are looking to replace your job income sooner, you might tilt more toward JEPI and DGRO. The secret to the dividend snowball is simple but difficult. Do not spend the dividends. In the beginning, your monthly payout might only buy you a cup of coffee. A few years later, it covers your internet bill. A decade later, it covers your mortgage. Eventually, it covers your life. The 2026 market will have its ups and downs, but companies that pay dividends have a vested interest in keeping their shareholders happy. By owning these 5 ETFs, you are hiring the best CEOs in the world to work for you. Which of these dividend ETFs is your favorite? Do you prefer the high yield of JEPI or the consistent growth of SCHD? Let me know in the comments below. If you want to see a deep dive into any of these specific funds, let me know that too. Don't forget to like and subscribe to start your journey toward financial independence. Thank yourself for watching, and I'll see you in the next video.